Hey guys, Jack here. Stick around after today's episode to hear how new clients can save 50% on AgYield's full suite of consulting and technology for 2025. This exclusive offer is available now until April 1st. Don't miss out. Terms and conditions apply. Check out the video description to learn more.
Good morning, everybody. It's Tuesday, March 25th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Overnight markets here at May corn down 3 1/4 at 461 1/4. May soybeans down 4 3/4 at 1002 1/2, and May Chicago wheat was down 2 1/4 at 546. No export sales announcements to speak of here this morning, so we'll jump right in. Very slow news going around right now. We're kind of in a holding pattern. It feels like going into next week. There's not much fresh to trade. Still keeping a close eye on the outside markets. In terms of guidance on the April 2nd tariff talk. You've got peace talks going on between Russia and Ukraine. They're supposed to put out a statement here this morning based on yesterday's discussions. So I'm sure the outside markets will be closely tied and looking at that. But outside of that, Ben, I guess what's on your mind? And we'll throw around the room this morning.
I think everyone's exhausted with really quiet markets. Corn for all intents and purposes has been in a 10, 12, 13 cent range here for a couple of weeks. Soybeans about a 15 cent, 20 cent range for the same amount of time. The market is, you just don't have people willing to step in and take either side of the market with so much unknown. I think the one thing that is probably the closest to being accepted as truth that we'll have a high acre number in corn. How high that is, or whether or not it disappoints is going to be watched closely. Quarterly stocks, and then of course everything that's coming out of DC. So just very uninspiring. I think that 7 to 10 days from now, you probably get a lot better picture, and we transition to maybe starting to trade some weather models and some things like that. I think that we will naturally start getting some headlines on dryness in safrinha, just as the natural progression to their dry season. But really, you just don't have people overly convicted today. Corn slapping between the 200-day and the 100-day, and it's not a fun trade. So.
No, I'd just like to fast forward and get to next Monday, honestly, and give ourselves a little something to talk about. Dustin, I know you've been kind of putting together some pre-planting, plans and things of that nature. I guess maybe share a little bit of, anecdotal things that you're seeing. I know now that we've wrapped up crop insurance, we're waiting for the 31st and guys to go to the field. But I guess, industry-wide, kind of what are you seeing?
Still negative margins. I mean, you're kind of thinking about how to position. A lot of that was actually done through the crop insurance decision. So, that was, I think a big part of just, we call them plan Bs. Like, what are you going to fall back to if we don't get the profitable selling opportunities that we want to get, in the typical seasonal window? So we'd hope to normally see is just the ability to make good, clean cash sales above our cost of production. And that generally, when we get those opportunities, it's usually the time that we at least want to do that. That's why we make seasonal highs, is there's peak uncertainty about production ahead. So we usually look for that in April, May, June. But there are many years where margins are quite low going into a year, and it never really gives us that selling opportunity. Like 2017 is a good example, right? I think the high that year was 417 midsummer. So what are you going to fall back to is the question. One good thing, and this might be kind of why markets are so weak, but so we have really strong farm bill this year. We have the PLC floor is coming in at 426. That's a huge increase from the last couple of years. The Art County price is 503. Crop insurance is set at 470 for corn, which is pretty good. Not so great at beans, 1054. So there's a lot of other things to potentially fall back to. And I think when you're at this type of negative margin where you're easily triple digit an acre loss for the average grower in the high rent district, what are you going to be able to rely on if it does turn out to be just a good growing season and prices fall back down to maybe even sub $4? I'm not predicting that to happen. I just know that that's usually where everyone's concern is going to be. And what do we have to, we start tallying up all these things. You have crop insurance, a few sales you might have, farm bill payments, there's at least some sort of backstop that we might be able to rely on as minimum revenue just to get us through another year as we hope to get cost of production down. And then, of course, you don't want to be the one grower that sells everything today because you're worried about Trump tariffs, and all of a sudden we get into a drought, right? And that you've kind of locked yourself into a loss. So there's the other side of that coin too, where you don't want to be too aggressive on selling either. So it is a rock and a hard place. I've been doing this quite a while, since 2007, and this is probably one of the hardest years that I can remember coming into a season this year and last year.
Yeah. So as you talk about, some of the backstops, the crop insurance and farm bill elections and things of that nature. I mean, with the 85% payment going out, the ECAP payments, as you talk about dollars per acre in terms of, on average between a corn grower, bean grower, those payments got them obviously a little closer back to break evens, but I mean, are still, I'd say on a dollar per acre basis, what are you average are you seeing?
You're saying for the recent payment amount?
Yeah, this upcoming year. So tag on
I think it's
35
just a Band-Aid on major losses. I think that your losses are already triple digits in that, and for many growers, again, I'm talking high rent district. So, it might if a grower had really good production and did some marketing and is not sitting with a bunch of inventory, it might help cash flow, but I don't think that your average grower made a ton of money last year. In fact, I think this is just maybe hopefully bringing a lot of people towards break even. In the last couple of years, we've had a really high cost production. I'm just talking purely university data like Purdue or FarmDoc. So what's $35-$40 an acre going to do when you're a lot of people are posting $150 losses, right? And they're posting it again for next year.
I guess that's my question: is what's that dollar per acre loss look like as we're starting the year for corn and beans on average that you've seen?
Again, I can't speak for everybody because it's not that everyone's having losses or everyone's having gains. It's just when you just go basic university numbers, the numbers don't work, right? So you have to have a really large yield to make things work, or we need prices to rise. And I think one thing that I know I probably sound like a crazy person talking about the real every day, but when the real drops 22% in a year, and you're a Brazilian grower that literally buys inputs, taking yourself out of that real for an entire growing season, and then you sell your output, your corn and your soybeans, putting yourself back into the real, but at a lower real exchange rate when everything's done in dollars. You had a currency arbitrage. You made money from the currency falling, and you were not part of that currency during that fall. So that's a big part of why global producers have been able to continue to produce and be profitable, is that they've had an advantage from the currency standpoint. It's made them more willing sellers. At some point, we're going to have to either have, in my opinion, some really big pain where cash rents need to start coming down. And that only comes through pain, usually, at least in my experience. Or, the rest of the world has to kind of catch up to the new cost of doing business, new cost of growing. And so one of the two things is going to happen. It's, it never ceases to amaze me how markets adjust in the end. 20 years ago, we might have been able to grow corn for less than $3. 10 years ago, we really couldn't, right? Now, maybe it's going to be hard for us in the future to, even with rising trendline yields, to grow corn for less than $4. Maybe $4 is our new benchmark low because of all this financialization of the economy that we've done and all the money printing post-COVID. Maybe the world just needs to pay up for higher corn and soybean prices. I mean, the time will tell. I'm trying just not to get people into a bad spot, right? Just trying to box out risk on both sides of the market, yield and price, and get through this year as a buy year. Definition of base hits, right? We're not going to be shooting for the one last home run to bail us out. We need to still be professional business people and make sure we're not losing the farm over the next year.
Yeah, that's a good point. Justin, agree, disagree, thoughts, I guess, as we wrap the greens this morning?
Yeah, no, I 100% agree. It is a rock and a hard spot, and there's a lot of variables, and the kind of inflation that we have, like, rent, seed, fertilizer, China's exported a ton less fertilizer on the global market. So those things have been really, really sticky, and it's not easy in a short, you have a lot of landowners that are, 1 or 2 generations removed from the farm that set rent prices, or investors. And, the fact that they paid $12,000 an acre, 15 or 20, and need a 3% return, and it's super competitive on rent. That just takes time to work through. And I think Dustin's on, it just takes pain, and it takes where there's enough people that just can't pay it anymore. And then like government programs, while welcome, make that really tough to clean out inefficient producers, or, it drags the pain process, longer, to be honest with you. Like if you have, we were talking about before the show, like when the ethanol boom started, and the bust happened, the inefficient plants closed down pretty quick. They got bought for 20 cents on the dollar, cleaned itself up. It's really hard with, big subsidies and farm bill. And like I said, it's really welcomed right now because you have a backstop, but at the same time, it's really hard to take production out of the market. It's hard to take acres out of production. It's hard to do all those things. And then you add in the South America issue that Dustin talked about really well. And they keep making money and are rewarded for expanding until they're not, right? There will be some turning point where that backfires the other way, right? It could be this, where meaning you buy inputs and the real actually strengthens, and then you have to sell your crop for a lower price, and that backfires huge. So they've benefited from that. At least we have, everything's based in dollars for the most part. So we have that going for us, but it's a tough one. I mean, I think I've talked about this a lot. I mean, I think domestic demand is going to be key, so that we're not as, influenced by South American currencies. That would kind of put us more in the driver's seat, I think, as we continue to build that. Be nice to see some more guidance on some of the biofuels. It's hard when you only work in like 3-year windows on these bills.
Mm-hmm.
So it's like, it's hard to ramp up because you don't know if you go spend a bunch of money and then that goes away. I think probably some of the issues with tariffs in general and industry coming here is like, well, is this going to be like a 10-year deal or 15-year deal? Like, can we go invest billions of dollars to do this? Because I like the idea, but is it going to backfire on me? So I think there's just a lot of that kind of stuff going on in the US anyway. So I'm kind of long-winded, but yeah, I do agree. It's just not an easy fix, to Dustin's point. It's not like, oh, let's just go sell a bunch of 450 corn because let's hope we triple dip and get, it goes to 3 and we've got really big payments and we can get out of this thing. I think it's a huge speculation one way or the other just to take a big stance.
Yeah. Kyle references this year being, 33% or so less profitable or at a loss than 24. So yeah, I mean, it's kind of the skeleton, the ghost in the room. I mean, we're just, guys are, if you can put the pencils away and not figure it out, but it's the reality of it right now.
Well, and Dust is being modest. I mean, yeah, university data is a great one because, that's just a third party that's analyzing, their information. But we work with a lot of different banks, and it's consistent across the Midwest of huge draws in working capital. It's not as good as people are saying it is out there. I mean, we felt this through, small banks, big banks, it's consistent. So yeah, you're going to have somebody that owns, a bunch of ground free and clear. Like, yeah, they can produce $3 corn probably and make money. But for the majority of growers do rent. When you look at acres, maybe not numbers of growers, but numbers of acres are cash rented, or a big chunk of them. So I would say definitely a majority are underwater, and not by a little amount.
Yeah, Justin, we've talked about it a number of times off camera, but this is the first year I can remember maybe ever in a career where you're within weeks of going to the field and you're unsure about securing an operating line. And I've heard that like story after story after story of that, and that's why I kind of referenced that ECAP payment, is that, there were folks that literally was riding on, them getting financing going forward or not. I mean,
yeah, no doubt. And Dustin made the comment earlier that there's been years, like 2017, which I agree and disagree. Yes, there has. I think the difference is that the speed of change has been the most dramatic that I've seen. We were going through, years 4 or 5 of like negative margins, or just kind of on both sides, where, if you didn't market very well, and you just kind of kept losing money, and there was chances in there to make money, where this is just, such a drop in prices and inflation, or cost of production that stayed or even improved in some, or increased in some ways. So the drawdown of working capital, I think, was much, much faster. So we're seeing these problems develop after like 2 years, not 4 or 5. So I think the rate of change of working capital is probably greater than we saw in any time that I've been here.
Yeah. Oh, very, very good. We'll keep everybody posted on what's going on with that. Ryland, as boring as the grain markets have been the last couple of days, you can't say the same about you boys over there in the meats.
So no, that's wild, for sure. It has been a wild ride, for sure. And yeah, not as much doom and gloom as in the grain markets, that's for sure. I mean, obviously we've seen some kind of a rocky trade the past 2 sessions, but beef market starting to pick back up here. Obviously, we haven't really seen any cash this week. I think overall, it just kind of throw a dart and see what sticks right now. But there really hasn't been, as we really haven't seen any liquidation, I would say, at least from what we're seeing as far as open interest goes. We were back up 33.28 in commitment yesterday. So there is some optimism, I think, that's still floating around here. I mean, we've seen this in some of our big bull market years, these big drawdowns, these big drops, these big spikes, and sometimes the market comes back. So, I mean, like I said, I think you just got a little bit of shaky ground here, but overall cash is probably going to determine the direction. We are in kind of a seasonally weak time frame. The next 2 weeks typically are not good in general. Just as far as price action goes, we've seen that in the 5-year, 10-year, 15-year kind of time frame. So it's something to be cognizant of. And it's something that we've been kind of preaching, just over the past several weeks, which is like, how much risk do you want up here, and how can you kind of reduce that? LRPs, put options, they're great mechanisms right now, I think, for certainty and time, just to kind of get us through, endorsements that are going out to like 30 weeks. Put a really nice price floor in the market here. Obviously, there's going to be varying levels of coverage and different expenses, but something like, a 192 floor or a 189 or 185 floor. I mean, these things it's obviously extra money to spend, but right now it seems to be worthwhile in our opinion, just from a profitability standpoint. So there's still a lot to do here. And I think certainty is kind of where everybody's focus should really be, rather than trying to outguess where the next move is going to come from. So that's overall still no cash though. Beef good. So we'll see how it shapes up today. But no, on the hog side, it's been kind of this lackluster trade. I mean, we saw a big down yesterday, just still kind of holding some of the support levels that we've seen over the past week. We do have a cold storage report here on Thursday, or cold storage report today and a hog and pig report on Thursday. So we'll see how the market tries to price this in. Right now, all hog and pigs are looking at 101.2, market hog inventory at 101.1, and breeding herd at 100.2. So we'll see if the market believes the report. After that, in cold storage, we'll see if there's going to be any stocks build seasonally like we would expect in bellies and pork. But as far as the price action, it's just been pretty sideways right now. I think a lot of the headline trade is scaring people off just with what's going on with Canada, with Mexico. So we'll see how it shapes up. But overall, just kind of a sideways market still.
Very good. Appreciate the update there. We just came into the open. We got May corn down 3.5, 461's the last. May soybeans down 2.5 is the last, 10.05. And May Chicago wheat's down half at 547 3/4. Got about a week and a half left on our special offer for new AgYield clients. Jack will have more info in the outro. But with the March 31st report coming, a lot of things to discuss and look over. Make sure you're, in a acceptable position for your operation as we go into planting. So give us a call. We'd love to visit with you. Appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like and certainly subscribe. Doesn't cost you anything to do so. And it'll keep you up to speed on everything that's going on with the AgYield. So again, thanks to everybody that supports the show. We're doing this live every day that the markets are open, streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate the thoughts and comments here this morning, guys. It was a good show. Hope everybody has a great day, and we look forward to talking to you again tomorrow.
At AgYield, we know that farmers are constantly confronted by new challenges, and 2025 is no exception. Markets are volatile, margins are shrinking, and lender confidence is in free fall. Farmers need industry support now more than ever, which is why we are offering something truly unprecedented. From now until April 1st, new AgYield clients can access our full suite of consulting services and cutting-edge technology at 50% off. This is more than a promotion. It's our way of extending a hand of support to farmers when they need it most. From precision grain marketing to innovative risk management strategies, we're committed to protecting your farm's profitability and building a stronger, more sustainable future. And together, we can weather the storm ahead. Visit us today at agyield.com or call 855-266-6241 to get started. Terms and conditions apply. Check out the video description to learn more.